Good evening, ladies and gentlemen. Thank you for your time. Much appreciated. My name is Aegis, and I have been managing the Flexi Cap Fund since inception. The just before we get started, a quick word for those of us who are joining us for the first time. This is an open-ended equity product, which is investing across large, mid, and small caps. The product is built for really investors with a long-term capital appreciation. If you look at the rating on the riskometer, it is very high risk, and this fund is actually meant for people who have long-term patience. Right. So, with that, I just want to set the context of today. So, what do we have that is lined up for you today? So, we start with this is the entire context that we intend to start with the description of what the fund really is, how we have approached it in terms of the investment approach, the construction of the fund. We plan to follow this up with a quick brief of how we're looking at the Indian economy and the investment landscape under which we're operating today. And given the signs and times that we are in, we will discuss about crude and the impact of crude and what it means really for the Indian economy and the markets. And finally, in conclusion, we'll tell you a little bit about how we're positioned today and the way forward. Right. With that context, I want to get started. For some of you who are probably new to us, I want to just set the context by telling you what is the investment philosophy of the firm and the fund. So the FlexiCap investment philosophy rests on three key pillars. The first key constituent pillar is rigorous bottom-up research. This is where we do where we assess businesses through a combination of primary and secondary research. We solidify our understanding of the business. We document all of this. We also typically tend to engage with the management teams, given the size of these businesses, to really have a very good solid understanding of what the business has to offer. On top of this, we couple several filters, which are effectively governance, earnings quality, capital efficiency, and leverage. What this really means is that from the point of time that we're looking at the business, can this business deliver earnings growth for the next couple of years? Capital efficiency is effectively looking at the return matrices of that business, and is it better than the cost of capital across time cycles. Leverage is typically where we prefer companies which have low leverage and are in a lower quartile of their leverage as compared to their peers in the industry, because typically if cycles turn, these companies with low leverage come out unscathed. And finally, we look at governance. As a fiduciary of your money, we are even entrusting leaders to run businesses. So this is a completely non-negotiable trait for us, where we look for governance quality quite materially. The next bit is really to talk to you about the fact that coupled with this, what we tend to do is we add the element of price, because we have once we filter all of these out, we have a GARP framework, which is growth at reasonable prices, and on top of that, we layer a risk of active risk control, and that is done through portfolio diversification, through maintenance diligence, and portfolio construction broadly. The investment philosophy that we're really trying to embody is to not really chase growth at any price, and there are several active risk control components, which again solidify the foundation to in order to protect capital even in such troubled times. Moving on. The next is, since I've explained to you what is the investment philosophy, I want to talk to you a little bit about the investment approach, because a lot of you will be trying to identify who we are as a FlexiCap fund. So this is really intended for you to have a very solid understanding of who we are as a fund. So when we were likely to go and launch a FlexiCap fund, we studied the markets, and we had a lot of learnings through that, and this is really an evolution of that process. So one of the things that we're really trying to tell you is that across cycles we'll have a base large cap allocation anchoring at about 40%, give or take, and the range that you will really see the fund navigate through from a large cap perspective will be 40 to 80%, which actually gives you enough room in the small and mid to have allocations between 20 to 60%. That is the first call out that we'd like for you to know, that as a flexi cap, we will levitate between large and small and mid caps as where we see risk reward being favorable. We're not ideally constrained by any market cap bucket, so we will go to where the opportunities are. The next is, what is the strategy? How are we looking at finding stock ideas? And this is where I'd like to sort of spend a little more time, because the portfolio has two distinct layers, and I'll talk to you about both of them in a little bit detail. So the first is the benchmark mindfulness element of it, and what this really means is that our underlying index is the Nifty 500. So if you look at names within the Nifty 500 which have a representation of 0.3% weight or higher, there are 70 such stocks which have a weight of 0.3% or higher. So these are large, well-known, well-identified names. And these 70 stocks actually represent two-thirds of the market cap of the Nifty 500. So these constitute the benchmark mindfulness. The second distinct layer that we have is the active bottom-up stock picking that the parent and the house is really known for. So this is the part which is below those 70 companies where the representation and weights are less than 0.3% of the index or materially lower. And there are 430 such companies in the Nifty 500 which represent a weight of one third of the market cap. Uh, and so that those are names where we will cherry pick the portfolio for, again, very active bottom up stock picking calls. What I'm also adding here in the active layer is that there are names which are outside the Nifty 500 which could be sector leaders in themselves, but because that sector does not seek representation or does not have representation in the Nifty 500, as a virtue of that, these stocks or small constituents are not represented in the Nifty 500, but we have a very active understanding of them as a house. We've probably looked at these names and we've met these promoters, but of course these are names which could be materially smaller. They could be sector leaders in themselves, but the sector representation is very very small to feature in Nifty 500. Or there'll be very low coverage on these names. People may not have heard of them, but what we're really trying to tell you here is that we will also have such names in our portfolio. So these are non-index names which are not represented in the Nifty 500, but you will see some of them feature, in our portfolio. From a guardrail perspective, what we've also tried to do is we've kept a limitation of the non-index names to a maximum of 25%. So really the reason to give you this split between benchmark mindfulness and active is for a simple reason that tracking the benchmark components ensures that risk is actually managed relative to the opportunity set. At the same time, active bottom-up stock selection is the primary source of alpha, because it allows to identify mispriced businesses beyond the index weight. So our entire endeavor through this process is really a combination of ensuring discipline, while preserving the flexibility to generate the excess return through differentiated insights. And just so that you are very clear, we use the benchmark as a guardrail, not as a Bible. It's more of a guardrail, and this helps to allow bottom-up conviction across the portfolio while keeping the factors and sector tilts within explainable, defensible bounds. So having told you what is our investment approach, our investment style, as explained to you earlier, is broadly growth at reasonable prices. The next thing that I want to tell you is very quickly that our investment universe is those 500 names plus 200 that we've been tracking outside the Nifty 500, and this pool continuously keeps expanding. So that's the broad investment universe. From this, there are about 100, stocks that are always shortlisted at points of time. And from this bucket, we're really looking to curate a portfolio of 40 to 70 names for you. So now that I've spoken to you about the investment approach and the investment philosophy, I want to actually show you how that gets implemented on in a real-time basis. So the next slide really talks to you about the fact sheet. So all the data that I'm presenting to you henceforth is on the 28th of Feb, which is Feb end, Feb 26. It's all available on our website, publicly available. So I'm just trying. I hope you can marry what we spoke to you from an investment approach to how it is translating to the fact sheets. So as you can see very clearly on your screen, our large cap allocation is about about two-third. Our small and mid cap allocation is about one-third. We have about 4 to 5% cash. The portfolio has a beta of 1, which effectively means that we're aligned with the market risk. We intend to or aim to capture more of the upside through our stock selection process. You can see that we have an active share of 60%. Which is really a reflection of how differentiated we are from the Nifty. And, given that I've been telling you about GARP, it's best represented through the PEG filter where we are 1.4. So we believe that we're buying reasonable growth at a fair price. Uh, and what I've done for you, because I spoke to you about components of the benchmark and active and non-index, I've also bifurcated the 54 stock portfolio in the same cuts. So if you see, the elements of benchmark mindfulness actually are 22 stocks out of the 54, and from a weight perspective, they're about 58% of the weight. And the active bottom-up stock ideas, which is basically part of the Nifty 500, but materially lower weight, are about another 22 names with about one-fourth weight. And there are about 10 non-index names which are there with a weight of about 14%. So I hope you're able to recognize that what we were speaking to you from an investment approach is getting translated into the fact sheets. And the next slide is really how we've constructed the portfolio since inception. So the funds units were allotted on 6th of June, and we finished our complete portfolio deployments by the months of August. And before I walk you through all elements, just so that you know what each bar represents, so the red bars are effectively the number of stocks that we've held in those representative months. The and I'm just going to use a laser pointer here. This line that you're able to see, the line of SMID allocation, is our investments in small and mid caps. In the last in the last 9 months, and the line on the top, if you can see the laser, it is effectively our active share. So, what I hope you're able to appreciate from this slide is that, we've consistently had an active share of more than 60% across since we've started. Our small and mid allocation has deliberately been actually in the 30 to 35% range. So you can appreciate that, we've been very thoughtful about how we've constructed the portfolio from a small and mid perspective. And the additional point I'd like to tell you here is that since the portfolio has been fully deployed in August, we have not taken any cash calls during this period. So we've avoided taking cash calls, and we've been broadly fully deployed. So I hope that this chart shows you that we've built the portfolio with a lot of conviction, not just to deploy the AUM quickly. The next slide is really very simply about the portfolio concentration curve. So if you see on this on the top slide, the top 10 positions are actually 38% of the portfolio, and the top 20 are about 59%. So what you're seeing, ladies and gentlemen, is a very well diversified yet concentration driven portfolio. The bottom half really speaks to you about the sectoral representation in the fund. So the top 10 sectors are actually 85% of the fund ballpark. BFSI is our largest sector, so we believe that this is a multi-year structural theme. And you can see the next best, the highest allocation from a sector perspective has been the healthcare. So there are sectors where we take meaningful overweight and underweight positions to really differentiate our style of investment, which I'll speak to you about in a minute. The next slide again is to for you to be able to appreciate of how we construct your portfolios. So this is a slide which talks about the 5 sectors where we've been materially overweight, and the 5 sectors where we've been materially underweight. And I'll probably walk you through a little bit of each of them. But just so that you understand what's there on the slide, So if you can see on the very left is the sectors. The index is actually the representation of that specific sector in the Nifty 500 as of the end of third quarter 26. The portfolio is actually the weights that we have in healthcare represented in our fact sheets. And the overweight is the difference to the portfolio minus the index, and correspondingly, it is the same for underweight. So, as you can see, the five sectors where we've had the highest amount of overweights have been healthcare, services, textile, telecom, and metals and minings. And our biggest underweights have been oil and gas, consumer services, FMCG, cap goods, and consumer durables. And what I'm really trying to tell you here is that overweight and underweight is actually a very deliberate call. And I can get into specifics here, but just to share quick two insights. Why are we, say, example, overweight a healthcare, right? So, the spectrum of healthcare today in the industry offers you several pieces, right? But today we've been indexed to hospitals and pharmacies, domestic proxies, and very niche export opportunity plays. And there's a reason behind each of these. So we believe that hospital demand, for example, is non-discretionary, it's underpenetrated, there's a lot of pricing power. The domestic franchisees, are benefiting from the shift towards chronic medicine. There's an improving business quality. There's a sustainable pricing power through volume and value. The export, the niche export opportunities are a good combination of formulation API, CDMOs. So all of this is very thoughtfully crafted, and that is why we would be materially overweight a sector. For example, in FMCG, you may want to know why are we underweight. So while we really like the prospects of the sector, we don't believe that paying very expensive multiples for single-digit growth earnings are how we should be positioned, because we are able to find better opportunities out there. These are very active views that we have taken. We own what we really believe in, and we avoid what we don't. And every overweight is a statement of our conviction, and every underweight is equal intention, actually. Right. So now that I've explained you the portfolio construction as well, I just want to quickly talk to you about the portfolio matrices. So what I'm really trying to tell you here is that if you look at the fund's EPS CAGR versus that of the Nifty, we're slightly better from a growth profile perspective. And if you take a look at the FY27 earnings multiple, we're broadly slightly modestly higher. So it's a small premium for a higher quality, higher growth portfolio, as of course reflected in the ROE profile of the portfolio as well. And we have a PG of 1.4. So we're consistent with our concept of CARP, and we're not basically overpaying for growth. So what we're really trying to do is to achieve better quality growth without really paying higher multiples. The next slide is the NAV movement. If you look at the cursor and the laser point, the black line is effectively the Nifty 500 TRI, which is our underlying index. The dark red line is the direct plan, and the pink line is effectively the regular plan. So as you can see, the journey hasn't been linear. There have been volatilities through the market, which is also reflected in the NAV. But what I urge your attention to is that this is a 9-month-old fund. We're still in our early days, and what matters more today is if the portfolio is behaving as expected, which it is. Very quickly on to the performance disclosures. So broadly, if you go to see since inception, and these are simple annualized numbers. Since inception, the direct plan is at 2.4, the regular is at 1 versus the index, which is at 1. Right. So now that I have completed broadly explaining you about the fund and the construct of the fund, I just want to quickly get into how we're seeing the tea leaves play out. Because the fund's performance does not exist in a vacuum. It is a function of India's macroeconomic story, which is a very important tailwind for the fund. Right. So just very quickly, the Indian macros from a decadal perspective, if you go to see India's real GDP growth rate continues to be structurally sustainable. The inflation has been broadly in the RBI band of 4% to plus 2%, either or, so 2 to 6%. We continue to be in that same range of 2 to 4%, which is significantly comforting. GDP growth rates, real GDP growth rates are expected to be in the 7% ballpark number. The fiscal consolidation is continuing on track, and the current account deficit is fairly modest and manageable. Of course, it's sensitive to oil, and we'll speak about that in a minute. But the intent here is to tell you that, India's macro foundation is probably very sound as we speak, today. But while the broad construct has been fairly robust, real GDP growth rate started to fall in between 24 to 25. So growth started to moderate, and the government recognized this quite early. And if you really see what the government has done in the last year and a half, has been to try to stimulate the economy, right? So the FY25 tax cuts was a deliberate demand side stimulus that the government proposed to raise, incomes, simplify compliance, etc. And they followed that through with stuff like the GST cuts, etc. So and GST rate rationalization has definitely unlocked demand, which was suppressed. And auto volumes are an actual real-time proxy for consumer demand. And what you're able to see on the right side of your screen is that two-wheeler, four-wheelers, CV, and tractor volumes have all started to pick up materially, which is a reflection of the broadening recovery across consumer and rural segments. Again, 24 was a year where liquidity was fairly tight. The RBI recognized the same, and there have been several measures that have been taken since then. The CRR, for example, which is nothing but a monetary tool where central banks have to, where the central bank asks the commercial banks to keep a percentage of their total assets with them. That has reduced, from 4.5% to 3%. Open market operations, they've infused more than 10 lakh crores into the system. So basically, this is supportive for credit growth and capex recovery. Again, flows have been fairly, supportive. We've had SIP flows. You all know this number. It's been 30,000 crores plus. It's basically helped cushion all the selling that has taken place by FIs over the past few years. And fundamentally, this is a very structurally different market from what it was 5 years ago, because India is far less vulnerable to FI mood swings. And finally, the question is all of this translating to earnings? So the answer to that, if you look at just purely data, the answer is yes. It is looking, the earnings recovery is quite real. It's broadening. And also the tariff headwind which was there is now hopefully turned into a tailwind. So what I'm really trying to tell you is, in a very simple nutshell, is that India's macro is very structurally strong. Policy support is continuing to drive consumption, liquidity, and credit growth. Which begets the most pressing question today, which is encapsulating the sum of all of our fears, which is crude, right? And that is happening because of the significant escalation that is taking place. And just so that lay out the data very quickly, if you see, crude was fairly benign in the $70 range. But when the West Asia conflict began, if you see, crude has spiked 40% in nearly 3 weeks. And that is material, because crude is not just a commodity for India. It is a macro variable, right? We import 85 to 90% of our oil needs. And when crude spikes, it impacts everything: inflation, current account deficit, corporate margins, sentiment, all of that, right? And broadly, if you look at the data, right, crude oil imports have been growing ex of the COVID phase about 4 to 5%. And we have a massive oil import bill, right? So in 23, when crude averaged at about $93, is how we recognized it. Our crude bill was 14.8 lakh crores. In 24, when it was broadly $83, it was 13 lakh crores. In 25, it was about $78. It was about 13.6 lakh crores. And then in the last 10 months, it's been $70, and our crude bill has been 10 lakh crores for the first 10 months. So this is extremely essential, and because it has a material impact on our economy. But essentially what the worry today, the escalation in the Middle East is really trying to tell you is that, and what crude prices are really telling you is that there's a deliverability risk being priced into market of crude. And in that context, actually $90 a barrel is a very critical barometer for India. And while it is a very critical barometer, there have been several instances in the past where crude has gone below or above that, which is why we're just trying to show you the sensitivity of markets to crude oil. So these are four time periods that we have taken. So if you look at the 2008 crisis, and if you see the black line, that's of course crude, and the red line is the Nifty 50. So if you look at the era of 2008, when crude spiked up above the 90 to $100 barrel mark, we saw a corresponding impact on Nifty. Similarly, if you see, the inverse is also true. So during periods of 12 and 14, when crude started to come down, there was a correlation that Nifty had where it started to move up. Similarly, for the case for 2014. And more recently in the 22 cycle, which is where I'm going to sort of explain you this chart a little more. We've had a recent event, the recent war that took place, not the current one, the recent one, which was the Russia-Ukraine war. We've seen something similar to our current times, and therefore, I think it's of pertinent interest to point it out to you. The Russia-Ukraine war, which effectively started around sometime around Feb to Jan, saw crude spiking very sharply, and the corresponding effect on Nifty, which had come down. And while crude stayed elevated even during the war, Nifty continued to be under pressure. And as the war continued to be a protracted, long-term war, but crude settled below the $90 mark, you saw that market side sensed a sigh of relief, right? And while it's difficult, what we're observing is a bit of a pattern here. So crude was benign, and crude has suddenly spiked up, and as a result of that, we've seen a correction in the equity markets. So really, that being said, our job is to actually be a capital allocator and account for risk. So the question is, how do we read this particular situation? So we don't know how to predict outcomes. So what we're doing is we're putting scenarios that could play out and how we're really preparing for those scenarios. So we put out three very simple scenarios. The scenario one is that there's a diplomatic ceasefire, crude retraces, markets see some relief, and the macros remain intact. Scenario two is where you see a prolonged low intensity standoff, like how we had seen with the Russia-Ukraine war. Crude stays a little elevated. It's range bound. Of course, India feels a bit of a pressure, but somehow manages through currency and subsidy levers. And scenario three is where crude escalates beyond 100 to 110 sustainably. And this would, of course, mean that it's a material headwind for India because inflation will reignite, fiscal math will get worsened, multiple set of things. So what we are trying to tell you is that currently how we're envisaging the situation is somewhere between scenario one or scenario two. That is what the portfolio is built for today. Currently, 16% of the portfolio is negatively affected by the rising crude oil, and 5% of the portfolio is benefited. So at a net level, about 11% of the portfolio is exposed negatively to rising crude prices. And we are currently, the portfolios are aligned to scenario number one and two. If scenario number three were to persist and crude were to continue to sustain at higher levels, we will need to recalibrate the portfolio materially. The situation is fluid, and we continue to see how things play out. Very quickly, given all of this, where are we seeing incremental opportunities today? We're seeing opportunities in financials. They continue to be multi-year structural themes. We're continuing to see very good opportunities come up in consumption. Here we're seeing effectively the shift from necessity to aspiration, value migration, which is premiumization and volume growth. Third, we're seeing opportunities in IT services. Stocks have been beaten down. Our belief is that AI fears may be a bit overdone. Large enterprises still need human accountability. And fourth, we see opportunities in the chemical space because the sector has been through a deep down cycle, so there's scope for mean reversion because margins and returns are probably at their absolute historical lows.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.